You probably think banks make money by helping people manage their money. After all, they offer savings accounts, loans, and advice. But the truth is far more shocking. Banks are profit machines, and most of the money they make comes from you often without you even noticing. Every deposit, every credit card swipe, every loan payment, even your small mistakes, generates revenue for the bank. They profit not only from interest but from fees, hidden charges, and even the data you create with your daily financial activity. Late payments, overdrafts, and unnecessary fees aren't accidents, they're part of the design. Even the way you invest or use your credit card can be turned into profit for them. Understanding how banks really make money isn't just educational, it's empowering. Once you see the system for what it is, you can take control, avoid unnecessary losses, and start using the banking system strategically rather than letting it quietly drain your wealth. Let's watch. 1. Interest on loans. The most obvious way banks make money is through loans. When you borrow money, whether it's a mortgage, personal loan, auto loan, or student loan, the bank charges interest. But here's the kicker. The interest rate you pay is almost always higher than what the bank pays you for your deposits. The difference between what they pay depositors and what they charge borrowers is called the net interest margin, and it's one of the largest sources of profit for banks. Mortgages, personal loans, and credit cards are all examples of how banks profit directly from your borrowed money. The longer the loan term and the higher the interest rate, the more profit the bank makes. And because banks often encourage borrowing, they profit from encouraging you to spend beyond your means. 2. Credit card fees and interest. Credit cards are one of the most lucrative tools banks use to make money. They earn in two primary ways: interest on unpaid balances and fees. Many consumers don't realize that a single late payment can trigger a penalty fee plus a higher interest rate, compounding profits for the bank. Banks also profit indirectly by rewarding spending. Cashback programs, points, and rewards are partially funded by merchant fees. Every time you swipe your card, the store pays the bank a percentage, often 1 to 3% of the purchase, regardless of whether you pay off your balance. In other words, your spending behavior generates income for the bank, even if you never carry a balance. 3. Overdraft and account maintenance fees. Another way banks profit is through fees tied to day-to-day account management. Overdraft fees, insufficient funds charges, and monthly account maintenance fees are incredibly profitable because they exploit common financial habits. Overdraft fees are particularly significant. Many banks require account holders to maintain a minimum balance or pay a monthly fee. If you don't meet the requirement, you're penalized. These charges seem small individually but add up massively across millions of customers, creating a stable, predictable income stream for banks. 4. Selling your financial data. Banks don't just make money from your deposits and loans, they also profit from the information you generate. Every transaction, purchase, or online payment creates data. Banks analyze this data to understand your spending habits, risk profile, and financial behavior. Banks can also sell aggregated, anonymized data to marketing companies and other financial institutions, turning your behavior into profit. By understanding how you spend, save, and borrow, banks can design products that maximize your likelihood to incur fees or interest payments. In effect, your financial footprint is a revenue stream in itself. 5. Investment and wealth management fees. For customers with savings, investments, or retirement accounts, banks offer wealth management and advisory services, but nothing is free. Banks charge fees for account management, advisory services, mutual funds, ETFs, and other investment products. Banks also earn commissions when selling proprietary products. In other words, they profit whether you succeed or fail. While advisory services can provide value, understanding how banks structure these fees is crucial to avoiding unnecessary losses. 6. Selling loans and securitization. Banks don't always keep the loans they originate. Mortgages, auto loans, student loans, and other forms of credit can be bundled together and sold to other financial institutions as securities, a process known as securitization. Through securitization, the original lender often earns fees at every stage of the loan's life, while the borrower has little visibility of how their debt is being sold or traded. For the average consumer, it's almost invisible. Yet this system is one of the most profitable tools banks use to scale their earnings, turning individual loans into billions of dollars in revenue. 7. Currency exchange and hidden service charges. Finally, banks make significant profits through currency exchange, wire transfers, and hidden service charges, often in ways that go completely unnoticed. Every time you travel abroad, send money internationally, or pay bills online, banks often tack on fees or manipulate exchange rates, quietly increasing their income. Individually, they may seem negligible, but collectively, they become a consistent and highly profitable revenue stream for banks. The reality is that almost every interaction you have with your bank has the potential to create profit for them, highlighting the importance of understanding hidden fees and managing your finances strategically. The truth is simple. Banks make money whether you succeed or struggle. They profit from interest on loans, fees on credit cards, overdrafts, account maintenance, and even from your spending habits. They profit from your mistakes, from small hidden charges, and from the data you generate every time you use your money. You can choose accounts, cards, and loans that actually benefit your goals rather than feeding the system. The banking system isn't inherently bad, it's just designed to profit first. Your job is to play smart, not emotional. Every decision you make can either enrich the bank or protect your wealth. Once you understand the mechanics, you stop being a passive participant. You can take control, avoid traps, and make your money work for you, not for the institution. Let us know in the comments what you think about how banks really make money from you, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.